Thank you so much. Prem sir, over to you.
Thank you. Thank you. And congratulations, Srikanth and the KFintech team for 4 tickets and for launching Ignite. It's a wonderful, wonderful initiative, and I'm sure it will bridge the connection between a registrar and the distribution community. And I think the saying goes that they saved the best for the last, okay? And I'm happy today to moderate this session with 3 stalwarts. The wonderful thing today is that the topic which has been selected and given to us is something which is so absorbing and it's so interesting. It goes beyond business. It actually asks us to discover the philosophy behind what we do. So let me start straight by talking about the conflict between managing AUM and between delivering performance, and what is our responsibility to investors. So I think that's going to be the crux of the discussion then. And for someone who has lived this conviction, let me first start by inviting Kenneth. Kenneth, when you were with a large institutional manager, I remember you had shut off the taps for one of your funds, which became the talk of the town. And have you done it again, repeated that thing?
And we haven't reached any critical size.
You have done that. So what drives you? Aren't you chasing AUM? You're a founder, and you want to obviously make it as big as possible, serve as many people as possible. So doesn't it go against the grain of the asset management business, which is gathering assets?
Well, my experience has been between, say, in the early 20s to my experience in the early 20s till 2020 has always been that you create alpha when you are reasonably small. The dilemma of larger funds is solved by that. I mean, the larger amount of alpha you create, the fund grows by itself. Okay, so there is a blend that you need to have between asset collection and asset management, and you have to navigate that reasonably well. And the idea of limiting flows is to make sure that you do well. Assets come in, you halt a little while, let the business consolidate, let the fund consolidate, and grow back again. So it's a step process. I think a large part of this industry has understood that, and what some of the institutions did in the first part of the 2000 decade. A lot of them have been following that step. So grow your assets, performance comes in, consolidate it, and then grow back again.
Okay, with this, I come to a more fundamental question, and Pankaj, you've also been with institutional managers for a long time before starting Ikigai, and you've had a spectacular start, at least in terms of assets gathered. So what do you feel is the dharma of an investment house? I want to go beyond banalities such as business objective, who do you serve? I want to know what is the dharma of an investment firm?
To me, the dharma, and I have watched it very closely, is that the person who is giving you the money, he is giving you with full trust and faith. I think dharma is to manage that money in that basic earnest. I think if you can, investment calls will be right, wrong, that's a separate thing. But the basic of fiduciary responsibility of an investment house should not be compromised. It could be in form of integrity. It could be in form of your conduct. It could be in form of when you see that sizes have become too large, you have to take care of the existing investors. It could be in various forms. But I think finally you have to give the investors who are trusting their hard-earned savings with you, that it is managed in the right manner. I think that's the basic dharma. Returns is just an outcome of that. I think what has happened over the last few years is that return has become the center point. And the entire thing around that, how returns get generated, is get diluted.
Sorry?
is getting diluted.
Okay.
So finally, what matters, people are saying, is outcome. But that outcome could be through various means. And if it's not sustainable in the long term, then people have trouble later on. So I think the way we look at businesses and stocks, I think that's the dharma which others have to also look at over a period. So it's a two-way situation. And I think my philosophy always has been do your best. Don't compromise your integrity. Try your best. I think that's what matters at the end of the day. So I think if we can keep doing that consistently over longer periods of time as investment house, I think that's the dharma.
So Ajay, you are about to launch your own AIF, right? That's going to be your first product. So as someone who's getting into this business, what is it that truly excites you about setting up this business?
Let me first start by thanking for calling me here, in fact. You know, for me, the basic difference when you talk about alpha and AUM is skill versus scale. That's the main difference. I have the two stalwarts out here for the skills, and I need to get the scale, in fact, actually. So that is always going to be a dichotomy. Now, how do you get that skill, in fact, actually? Is it through the active? Is it through the quants? Is it through the passive? Is something which always going to be a game of understanding, in fact. I've already built up the asset management in the past, in fact, actually, in international also at the levels. And if you see the statistics out there, in fact, actually, we will find that 50% of the funds struggle to give alpha. And if I have to talk about, and alpha is generally means that I'm able to actually meet the benchmark or whatever the benchmark is set. And if I actually make the alpha a little higher, which is +2, then it becomes just 34% only. So that shows exactly that at the end of the day, how do you actually bring that skill? And this is exactly what we are trying to bring in the market, in fact, that with the data which is available in the market today, the information arbitrage is slowly now getting away. And if the information arbitrage goes away, then the data is going to play an important role. And we need to therefore change our skill sets from due respect with the individuals to the machines, in fact. So for me, I think probably we are looking at creating the whole new skill sets, which obviously will, by the grace of God, give the scale also the same point of time. And yes, there comes a time where you need to balance out both, in fact.
Okay. Kenneth, one observation which I shared with you just a little while back was the fact that mutual funds are being increasingly set up by individual founders. Okay? This was not the case when all of us started our career. They used to be huge corporate giants, or they used to be banking institutions, right? And today you find that founders like you are setting up fund houses. Is it going to make a difference to the outcomes as far as the investor is concerned? Will we see more risk-taking? Will we see more independence? Or how will it impact? Or will they be under the pressure to survive and hence cave in to whatever practices that the market might demand of them?
I mean, the latter part of it, every industry goes through it. You do have a consolidation over a period of time, and then you have an expansion, and then you have a consolidation again. As far as institutions versus entrepreneurs, or institutions versus fund managers actually putting a business together, or putting an asset management business together, I mean, you don't even need to doubt it, because this is what's happened globally. Okay, in the conception of every asset management business globally, you always had a financial services company that actually dominated. Financial services, or companies in financial services, dominate the landscape in asset management. It is portfolio managers, fund managers who did well in that tenure that actually came out to set up different funds all over whether it's in the West or whether it's happening in the East and China and now in India. I think that's the grain of how it will evolve. Some will get huge scale, some will not get scale. You will go through that consolidation process. Whether they are successful, I think we're at that inflection point, at least in India as I see it, or as I think we will go down, is that a number of styles and a number of products that will come through together will be far different from whatever has happened in the past. All financial institutions did put products together. They went into talent. They got talent from the marketplace. They were very active managers. And now you see the trend of those larger companies that are there. They are moving passives. They are trying to get more scale. They are getting listed. They have to answer their shareholders in terms of growth, etc. Okay, that may not hold true for any entrepreneur turned, any investor turned asset manager on the ground. So that model will evolve. I don't know how it will, how it will get scale, and what's going to be the outcome after a decade. I'm pretty much sure there'll be a lot more fund managers who will step out, acquire asset management licenses, because today it's much more easier to get an asset management license than it was even 5 years back.
Pankaj, I want you to answer the same question. I just thought I'll add one personal experience to it. So I had flirted with a foreign fund house for a little while. And when I joined them, I found out that the internal rules, because they were completely risk averse, were counterproductive, in my sense. I'm never pretended to be an investment expert, but it was obvious to me that by setting up so many constraints and limits, you're going to be making the fund manager just become a closet hugger of the underlying index. So do you think because people like you don't have such constraints, you will be able to deliver better outcomes to your clients?
So my belief is that every fund house will have a different philosophy, but the boundary should be drawn in every fund house, right? Within that boundary, आपको जो करना आप करो. And whether it be a boutique manager or an institution, I don't think you can run all over the place. I think risk is important, but what I tell my investors is sleep-adjusted return rather than risk-adjusted return. Sleep-adjusted return, that you can have a good night's sleep when you're investing. And that can only happen when you have drawn the boundaries. The boundaries could be more flexible in this case compared to a large AUM and a large asset manager base. But I think finally, consistent outcomes can only come if you have philosophy and a right boundaries drawn in. Otherwise, it can lead to accidents also. So we have seen in the past, many a times, when you don't pay respect to risk, when you don't pay respect to portfolio construction, at some point of time, you ought to make mistakes. It's a 7-10 game or a 6-10 game rather than 10 out of 10 game, right? And when those 3 or 4 call goes wrong, and you have not paid respect to that, and you have gone overconfident, I think that leads to accident. So in the last 15, 20 years in our industry also, we have seen that there have been many accidents. Those funds have not been able to recover again. And that was only because you crossed your boundaries or you didn't respect the risk part. So I think whichever platform you work, irrespective whether I am an entrepreneur, whether in an institution, X, Y, Z, I think if you don't respect the boundaries, you will pay a price for it. So I think irrespective of whatever you are doing, whichever platform, it could be flexibility more, but you have to pay respect to that.
Okay, Pankaj, give me one example of a boundary that you've set for yourself at Ikigai. One example of how you've set a boundary for yourself.
Yeah, so clearly, for example, I'm speaking at Tamil Nadu Investor Association tomorrow.
Okay.
Everybody will speak about what to buy. My thought is that what not to buy is also extremely important in our markets, and especially in this time where everything is looking great. So we have a forensic entire framework where most important is cash flow conversion. I think in this market, people have forgotten the basic hygiene that finally equity value is nothing but the future cash flow discounted to present. And if you don't generate cash flow, there's no value of the business itself. But people get carried away by EBITDA, PAT, and top line, and that's the dharma. But I think boundary is very clear that over a period of time, if companies don't deliver 60 to 70% conversion of your operating profit into cash flow from operation, it will not find flavor in our portfolio. And there we have 6, 7, 8 parameters we have drawn for ourselves, which will make sure that maybe we deliver 1 or 2% lower return at times, but we will not meet with any accident per se, which can lead to stocks becoming penny stocks. And the worst phase for my life in my career, I am no shame to say that, was 2017. And that was a time when I massively underperformed. Because Vakrangi was going up, PC Jeweler was going up, Manpasand was going up, Cox and Kings was going up, you name it. And those market cap, Kenneth also remembers, had gone to 50,000 crores, 60,000 crores. And as public managers, we are naked, right? Every day is the report card which used to come in, right? Okay. People used to say, kya ho gaya hai? Right? Lekin wo boundaries made us, protect us. And 2018, when ILNFS and Yes Bank started to happen, you saw that how skeletons every day started to come in. And you stood tall.
Okay.
So I think time is the only measure.
Yeah, Pankaj, you raised something that I want to discuss a little later. But Ajay, tell me, you worked overseas, you managed wealth, I'm told, of family offices, of the royal family. When you are allocating funds, does it excite you to give money to someone who's a founder managing his own investment firm? Or does it excite you, oh, I have to give money to the world's largest investment firm. Look, they called me to New York. They hosted me. What excites you? What has excited you?
Excellent question, and very appropriate also. But I'll be very honest with you. When it comes to families, they never get carried away by the big names. They always are worried about that individual to whom the money is going. It's basically the more mass affluent or aspirant rich who would like to have those parties, in fact, and be shown or be seen about, in fact, actually. Not the ones who are actually rich, in fact. They will go by that individual. And coming to the point of what Pankaj was talking about, the boundaries, see, everybody starts with the alpha, all of us. But then comes a time when you have to look at beta also then. And that's what the families look at, in fact, actually, when they look at allocating, in fact. And honestly, that is the one most important thing in the international market which people look at. And that is why I'll give you another statistics, in fact, actually, that if you look at the growth of the passive funds, why it has been there. Because on the active side, if I leave the magnificent 7, they have not been able to do anything, in fact, actually. Just those 7 stocks have been doing. So where exactly, therefore, the money will go? So therefore, it becomes very important for a person who's managing the beta as an individual, no problems.
Okay. Pankaj, coming to what you raised, how much of pressure do you face when you find other fund houses doing better and your salespeople coming back to you and saying, देखो, वो उसका performance देखो, अभी market में कोई खरीद नहीं रहा है, अभी सब लोग उसका बात कर रहे हैं, उसके पास पैसा आ रहा है. Your CEO, I mean, in your erstwhile jobs, telling you that boss, अपना market share तो negative है, उसका तो इतना positive है. How do you face these pressures? How did you face these pressures then, and how do you face these pressures even now? Because I know that you are obviously going to be collecting money on an ongoing basis.
So I think this is an ongoing journey, I think, right? 22, 23 years on a mutual fund platform, you have seen it all. And I think I have seen the moment you succumb to something which you don't believe in is the end of your career. And I've seen it in many cases in front of us, that certain things you don't believe in, but because your thoughts and beliefs are not coming true, you succumb to that pressure, and finally, on the hindsight, you feel that that was the worst thing to do.
Yeah.
2017, as I said, 8-9 months when you are underperforming massively, stocks are going up, flying. Even a panwala comes and says that, boss, aapka time ho gaya. Right? A small kid. Panwala means a small kid. I think you have to take with all humility at that point of time and go back and keep checking whether is it your arrogance or is it your deep research which is giving you that outcome. I think there's a very fine line. Many a times we all fund managers get so biased emotionally, mentally, that even if we are going wrong, we don't want to correct it. I think that's something which you learn over a cycle, that finally market is the right. You have to respect that at some point of time if you're going wrong and correct yourself. So I think you nurture it over a period. And I think finally, if you are convinced about something, stay on the course. And I have been very fortunate every time that my bosses have been super supportive of my research, of my conviction, and they have given me long rope. Investors have given us long rope at times, and I think that's the way you come back. And when you come back and your conviction is proven true, I think the respect which you gain. तो मैं ये बोलता हूँ, मंदी में फंड मैनेजर इज्जत कमाता है और तेजी में कोई और पैसा कमाता है. इज्जत तो मंदी में आप कमाओगे, because जो आपकी प्रोसेस है, that will make sure you stand tall when the world is falling down. So I think that's the way you do it, and I think keep doing it over a period of time. Don't deviate too much. You will be okay.
Kenneth, I want to talk to you about the big paradox of the markets. You know, when the markets are high, there's a lot of excitement. Distributors want obviously think it's a good thing. Investors are lining up, queuing up to invest money. And there may be a lot of froth in the market. So how do you manage this paradox that the highest interest in a fund, in a sector, overall industry, is when the going is good, and when the probability of making money is the least?
I'll borrow some sentences from Pankaj. See, you just don't have to make mistakes. That's about it. I keep saying this, that great companies are not always great stocks. Okay, but there's always a time in the marketplace that you'll be able to buy a business that you like, but not at the right valuation. So that's where we start. And for some reason, if the broader segment of the market actually comes off, you should have enough firepower with you to make sure that you can average your costs down. Because at the bottom of the market, you don't get money. At the top of the market, at the top of the cycle, you get all the capital that is there. So this is a push and pull of our industry, but that's the way it is. At the top of the cycle, we just make sure we don't make mistakes, and that's what 30 years in this industry has taught me. 2008, we were on the right side. Year 2000, when I was an analyst, I was on the wrong side. It's all about patience, discipline, and right now, just make fewer mistakes as time goes by.
Okay. So, Ajay, there's this paradox of markets that the interest is highest among investors and distributors at a time when the probability of making money is the lowest. So how do you think you will manage this paradox once you start your business?
So that's the reason why I'm giving the machines all the advantage. In fact, actually, it takes care of that particular irony and removes that particular cacophony or anomalies of the market, in fact, and gives you the decisions which can be made, in fact. Of course, the active management will continue, but if you see the whole markets or the whole world which is going towards the quants or towards the passive side of it, shows exactly that at the end of the day, people are looking that I don't want to get carried away. As Pankaj and both Kenneth mentioned, the discipline, that brings actually a more discipline, in fact, actually, and make sure that you're able to take forward whatever you are convinced was, in fact.
Okay. But talking about my last question to the three of you, is the solution passive funds? Because if you follow a passive strategy, an index fund will not underperform or overperform. Is that the solution to being fair to the investor?
I don't think so. I think India has a long way to go in terms of active management. Though there has been a narrative which has been brewed around that what happened in US, 56-60% of the AUM now is into passive. India is also progressing towards that. Just pay attention to 2 minutes. It's a very interesting data point which I wanted to share with all of you. We looked at the data from 1998 to 2025, a 27-year almost period, right? And 50% of India's stock move, when you take the NSE 500 entire universe, 50% of stocks move by 50% from their one-year lows. That number in US is about 33%. So you get huge upswings and downswings in an Indian market over a 25-year period on the top 500 stocks. Now let's look at the second data point, which is the median move of those stocks from the lows. It's about 58-59% compared to 30% in US. That means for an active manager, it's a great place to be in to generate that alpha. And the third most important is that, and it's a public data, that the highest number of multi-baggers in India, 2x, 3x, 5x, 10x, is out of India itself across the globe. Highest number of multi-baggers. So for me, for the next 5-10 years, at least in the space we operate, me, Kenneth earlier also and now also, which if you remove the top 100 stocks and the rest of the entire 500, 600 top, the next 500, 600 market, I think active management is still kicking. And last but not the least, don't forget that in the index, especially the mid and the small cap index, you have a lot of junk stocks which become a part of the index just because of the free float. It's not because they are great companies, they have done well, but because of the free float being high. And over a period, we have seen that when you buy that index, you get that junk stock also, right? We saw that in 2017 bubble. We saw that a couple of years back also. So I think in this space, I believe maybe large caps passives can work. But I think next 5-10 years, if you want to venture into that, I think active is still kicking. And data provides that Indian fund managers see that dispersion, has that long, fat tail where you can generate that alpha over a period of time. I don't know.
Kenneth.
Well, I got a bias towards active because I'm an active manager, but I think, you have passives and actives that will both coexist, and I do hope passives get larger because that's what creates the space for actives to outperform. So as long as money is chasing passives, they're ignoring something which is out there, which turns far more valuable. That's the space that I think we would want to operate in, and that creates a larger opportunity. So active's not going to die. Even in the international, even in the developed markets, you have almost 15% of managers that do actives and have succeeded over longer term periods to beat the markets.
Yeah, just to share one more data with Pankaj, in fact, actually, if I take the data from 1984 to 2025, we will find that 50% of the active funds are underperformed, in fact.
Large caps, yes.
So my point is, once again, going back, I have all the respect for the active managers, nothing to be taken away from them. But at the end of the day, the active managers were available in India because we did not have data. We were actually in the information arbitrage. So active managers were able to get that information and use it for the purposes of making that money. Today, with the amount of data which is available, because now we are a very, very strong economy with data, in fact, this data will actually help you to make your decisions and will actually ensure that you are able to make right decisions. Even if I take the example of somebody getting into the index, the machine or the skill sets will actually tell you that even if it is there, it'll throw you out after a while, in fact, actually. So that's a very important, in fact, aspect of it to look at.
Okay. Okay, with this, we come to the end of the discussion. And thank you for being such a wonderful, answering all my questions. I did try to play a bit of a devil's advocate, but you were so gracious. And thank you all for staying back right till the end. It's rare to see a conference hall being so full of people listening to these sessions, paying so much of interest. And that's a big tribute to all of you and our speakers. Thank you so much.
Absolutely, sir. As you rightly said, we did save the best for last. Thank you for sharing those nuggets of information and ending this conversation on such a thoughtful note. Can I please request you to remain on stage for a few more moments? And now to felicitate our experts, I would like to invite Mr. Senthil Gunasekaran on stage, please. Can we welcome him with a round of applause? And let's begin the felicitation with Mr. Prem Khatri. All right, next we will felicitate Mr. Ajay Arora. Now let's felicitate Mr. Kenneth Andrade. Ladies and gentlemen, this is the last session, and it was a wonderful session indeed. Let's have a huge round of applause finally as we felicitate Mr. Pankaj Tibrawal. And now, can I please request you to step forward as we would like to capture this wonderful moment as a memory. One last time, can we hear it for our wonderful experts?